This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the AJ Bell Money and Markets podcast. I'm Laura Suter and today we've got a packed episode for you. We'll be delving into the latest consumer spending data from Barclays, exploring how saving can help you sleep better at night, and discussing the latest developments from housebuilders Vistry and Barratt. Plus, we'll be reviewing the US second quarter reporting season, and we'll be looking at the significance of a profit warning from recruiter PageGroup. Joining me today to break down all of these topics is our resident market expert, Tom Sieber. Hi, Tom.
Hi, Laura. Also on the show today, we've got two fund manager interviews, one looking at the UK property market and the other talking about an alternative source of income for investors. Looking forward to today's discussions. Let's kick off with the latest consumer spending data from Barclays. The data gives us a detailed look at how people are spending their money across various sectors. What does it say?
So it won't be any surprise to anyone that there's been a little spot of bad weather, which I think is basically the topic on everyone's lips in the UK at the moment.
Yeah, I've lost my sense of humour about it, I've got to say at this point.
Yeah, I think July, and I'm currently recording wearing a cardigan, is just not. It's not palatable. But the other knock-on effect that it's had is on consumer spending, because kind of understandably, when it's rainy and wet and cold outside, people, A, don't want to go to the high street and traipse around the shops and go shopping. And B, they're not really stocking up on those kind of summer essentials or summer holiday clothes like they normally would. And that has had an impact on spending. The flip side to that is there's been more time indoors, and so people are spending more on what are called insperiences. I can't decide whether I like that jargon.
Yeah, I'm not a huge fan.
No, but essentially this is kind of spending money on things that you're doing while you're staying indoors. So streaming services, for example, so things like Bridgerton hitting Netflix means more people have signed up to streaming services, but also things like kind of takeaways, spending on nicer food to eat in. So those are kind of some of the big trends that we saw. Now, Barclays, I should say this data is kind of taken from all of the spending that's done on among Barclays customers, and it has a pretty broad reach, so it's quite a good indicator of where the nation is spending its money. And what it showed is that essential card spending fell by almost 1% in June when compared to the same time the previous year. And that's the lowest year-on-year growth since April 2020. Now, part of this also will be that prices are easing. So when we look at things like spending on groceries, spending in supermarkets, that's dropping. Partly that is down to the fact that prices are now finally dropping. We've seen inflation ease, so those price hikes aren't quite as high as they were a year ago. But also people are still shopping around for bargains. So even though lots of people are reporting, seeing that those food prices are dropping, actually people are still in their bargain hunting ways that they have got into over the past few years. So looking for kind of cut price items, own brand items, or deals. And I think a really key factor where we see the impact that the weather has had on people's spending is that 39% of consumers said that they have spent less than usual on summer products this year because of the weather. That comes down to clothes, but also things like barbecue equipment, food. If you think when the weather's good, people might have people over for a barbecue or, summer parties. We've seen a real drop off in spending in those areas. But the wet weather and the bad weather does drive people to other things, and cinemas have been one beneficiary. So on a rainy day, particularly if you've got kids that are off school, which I know you do at the moment, Tom, the cinema is a good safe haven. And we also had Inside Out 2.
I'd say that was huge, wasn't it, in terms of box office? So.
Yeah, exactly. And actually, according to Barclays, cinemas had the busiest day of their year so far on the 15th of June, coinciding with the launch of that film and also the bad weather. And also, unsurprisingly, people are spending on summer holidays, because if the weather's bad at home, then there's less incentive to stay at home. And so we saw spending on holidays rising, and partly that will be because people are kind of settling the final bills for their summer holiday where they've previously paid a deposit. So interesting spending. And I always find it interesting how kind of smaller things like the weather or certain key events really impact how we as a nation spend across a month.
Yeah, it's a bit of a kind of butterfly effect, I suppose, isn't it? So next up, we're going to talk about some fascinating research which suggests that saving money can actually help you sleep better at night. So Laura, can you tell us a bit more about that?
Yeah, so this is some new research that's come out. And I think partly the logic of it really makes sense, but I think it's interesting that some scientific research has borne this out. And it basically shows that if you are regularly saving, then you will sleep better at night, is the link. Now, what's interesting particularly is it's not just sleeping better at night. It's things like helping people relax, feeling more optimistic about the future, improving their sleep quality. But what is also quite key is that it's regular saving and it's not pegged to a certain amount. So it's just that act of putting a little bit of money away can help you feel much more, mentally well, much more relaxed, much less anxious. So I think it's a really interesting reminder that while for some people, particularly as we're at the kind of gnarly end of the cost of living crisis, it's quite tricky to find a bit of money to put away. But even the benefit of putting £10 a month away, £20 a month away can have a real impact on your mood and ultimately on your sleep quality.
Yeah, and I suppose it shows that, you said obviously it could be quite a nominal amount really, that if you go to the trouble of sort of checking where perhaps, you've got a subscription you don't need, or you haven't kind of bartered with one of your like service providers recently, why that could be a real benefit, because then, you might find sort of £75 a month or something that then you can start squirreling away, I guess.
Yeah, exactly. And the research from Bristol University did find that, other life events, so things like getting married or having children, moving home, have a larger impact on mental well-being. But if we think about those are big life changes. Actually, setting up a small amount of savings or a small regular savings or investing is much less dramatic change to your life and kind of much easier to implement for the average person. So I think it was a good, interesting reminder of the mental well-being benefits of organising our finances and getting into that savings habit.
Yeah, no, absolutely. Intuitively, it makes sense. So it is interesting to sort of have that backed up by academic research. Speaking of things that can also keep you up at night, let's turn to the financial markets.
Yes, which we've got some positives and some negatives, I think. But let's turn our attention to the housing market first. So this has been a big topic as we've had a new Labour government. We've had some recent planning news from them. But Tom, you've also been looking at the latest results from Vistry and from Barratt Developments. So tell me what the latest is there.
That's right. So just days after the election, the incoming Chancellor, Rachel Reeves, gave a speech where one of the key elements was a revamp of the planning rules. And that's something that if you followed the house building industry, executives in that industry have been crying out for some kind of reform there for years. But if Labour were hoping that was going to be an easy fix to get developers building loads of new homes, then the results from Vistry and in particular Barratt Developments that followed it shot that notion down really. So Vistry, which is a bit of an outlier in the sector because it's pivoted much more towards regeneration and affordable housing recently, commented that the wider housing market did remain quite constrained. And Barratt Developments was also very cautious. And I think the crucial thing is that it expects to complete fewer homes in the current financial year. So that's the year running to June 2025 than the 14,000 that it completed in the year just ended. So they're looking at between 13,000 and 13,500. Putting that into a bit of context, that's only modestly higher than the COVID-affected 12 months to the 30th of June 2020, when completions totaled 12,600. So I think looking at that in the round, the conclusion to draw is that while planning will help, house builders are only really going to ramp up their activity when they see clear signs that demand is returning. And the kind of driver for that is probably some movement on interest rates, which will then kind of feed through into more sustainably affordable mortgages. There was one kind of slightly brighter note with Barratt. So it is expecting to be a bit more active in terms of land buying in the year ahead. And you could sort of take that as a bit of an indication it is planning to be a bit more active on building in the future.
Yeah, I think that interest rate cut is such a key factor for lots of different things that we talk about and people's finances. And we know there's no meeting in July. The next meeting is 1st of August, I believe. And so all eyes will be on whether a rate cut happens then or whether the Bank of England will want a bit more distance between the general election and the new government and its first rate cut. But let's look across the pond now. So we've got the US second quarter reporting season is about to kick off. So Tom, who is going to be reporting and what things should investors be looking out for?
Yeah, so as you say, it all kind of gets underway tomorrow. We're recording on a Thursday, so the 12th of July. And there's quite a lot riding on this set of earnings, really, given that you've seen US indices continue to make new highs throughout 2024. And on that basis, investors will be looking for companies to sort of surprise positively. So, report earnings and revenue that is ahead of forecasts. And they'll also be keeping a close eye on what the outlook is, crucially. And on the basis of where valuations are, certainly in some pockets of the market, if companies aren't delivering on either of those, they could be quite heavily punished. I guess, as everybody's probably familiar with at this point, the technology sector is an area where expectations are pitched particularly high, given the continued influence of the all-conquering AI theme. And on that basis, the week that commences the 22nd of July, when you've got Microsoft, Tesla, Alphabet, IBM all slated to release earnings, that looks like that could be quite a crunch period, as does the following week, actually, when you've got ARM, the Cambridge-based chip designer, you've got Facebook owner Meta, got Amazon and Apple all scheduled to report. To be fair, investors will have to wait until the end of August for the stock of the AI boom, Nvidia, to report. And another thing, I think, separate from technology, which is likely to draw a lot of the focus to watch out for, is some evidence that perhaps the spending power of ordinary Americans, which has been remarkably resilient given higher interest rates, that it might be starting to wane a little bit. You have certainly seen some commentary from companies in consumer-facing sectors that that's happening. So the results from McDonald's on the 29th of July and from the likes of Home Depot and Walmart in the middle of August could be quite telling.
And we'll obviously bring you updates as those results come out on the podcast each week and delve into a lot of those figures. But lastly, let's discuss the profit warning from recruiter PageGroup. I think it'd be interesting to talk about, what led to it, but also why it might have a bit of a wider significance for investors.
Yeah, 100%. So PageGroup got a very big kicking from the market earlier this week as we record. So it fell as much as 15% off the back of a profit warning. And its shares were trading at 12-month lows in the aftermath. And actually, subsequent to that, rival Hays also produced a pretty downbeat statement, although it fared a little bit better than PageGroup, partly because it's managed to keep a lid on costs. But I think another sort of telling thing, apart from the fact that it was warning on profit, was that Page observed that some of these kind of key indicators for it, like new jobs registered, the number of interviews that they've set up, have declined, and that both candidate and client confidence remain pretty low. So that suggests that there aren't too many chances of improvement in the short term. And looking at both Hays and PageGroup, the weakness was across kind of pretty much all geographies, with some exceptions. So, I mean, obviously that's bad news for PageGroup, but where it has wider significance is that the trends in the recruitment sector are often a bit of a leading indicator of what's going to happen in the broader economy, because companies, if they're doing their jobs right, should have a fairly good sense of what economic conditions are going to be like. And if they're pulling back on hiring, that suggests that they're a bit uncertain about future growth. Another area in which it could be quite significant is the outlook for interest rates, which we touched on earlier, because central banks tend to monitor the labour market and particularly growth in wages very closely, because if wages are going up and consistently going up at high rates, it can lead to inflation becoming more entrenched. So arguably, these very negative signals from the recruitment sector could be a signal that there is a bit more scope for central banks to cut rates.
But let's not get everyone's hopes up too much. But
no, I know.
Next up, we've got the first of two interviews. So we obviously touched on the house building and property sector earlier in our chat about house builders, but we thought we'd delve into that sector a bit more. So Tom caught up with Matthew Norris, who's an advisor to the Gravis UK listed property fund, to find out how he sees the UK market right now and also what makes that fund different from other real estate funds.
So this is a fund, a property fund with a bit of a difference. Could you briefly explain to me, Matthew, what the strategy employed by the fund is?
Yeah, sure, Tom. So the Gravis UK listed property fund is a fund of specialist next generation owners, developers and operators of real estate investment trusts. And at Gravis, we focus on 4 mega trends. So aging population, generation rent, digitalization, and urbanization. So really key specific mega trends where investors can benefit from secular multi-year tailwinds.
Great. And why do you think property is a good way of playing some of those themes?
Yeah, so this is a source of natural income, so that's great news for investors.
Yeah.
If you look at aging population, for example, the UK is clearly an aging population. The over 85s is the fastest growing demographic cohort out there. They are big users of healthcare. And so how do you play that through property? You really want to invest in modern, purpose-built GP surgeries, primary healthcare assets. How do you get access to those? Well, via the REIT market, so Assura, PHP. That same elderly demographic dynamic is a tailwind for care homes. So again, the REIT market plays its part in providing the next generation modern purpose-built care homes. So Impact Healthcare REIT, Target Healthcare REIT. So that's the aging demographic mega trend. If you look at GP surgeries, primary health facilities, that's basically government-backed income. That's great news for investors. If you look at the digitalization mega trend, a quarter of what we buy in the UK, we buy online. When you buy online, it requires 3 times as much warehouse space as traditional offline retailers. That's great news for the landlords. So, Tritax Big Box owns Amazon's largest distribution facility in Europe. It's at Littlebrook in Dartford. So with Amazon as your tenant, with Amazon investing in robotics and automation, great news for rent collection. If you look at generation rent, I'm sure some of your listeners will be in the same position that I'm in. My eldest teenage daughter's at university, going into her second year. She'll stay in purpose-built student accommodation. Here in London, 4 students for every 1 bed. Who's developing this next generation of purpose-built student accommodation? It's the likes of Unite Student, and they are the owner and operator of that asset. And for your listeners, generation rent is probably the fastest rental growth in the UK. And then within the urbanization megatrend, green is the new prime. Green offices are the primest offices. They command the rental premium. And one point of distinction between what we do at Gravis and what others do, we avoid the value traps. We avoid secondary assets. We avoid secondary cities where there's a yield trap out there. So mind your eye on the old-fashioned let and forget property. and we'd suggest focusing on the next generation mega trends.
That's really interesting. I mean, do you find that you have enough choice within the kind of UK REIT universe to do what you want within those trends?
Yeah, so look, we have good choice of specialist REITs. So we definitely have a bias towards experts in their areas, specialists. Yeah. We don't invest in the generalists. We don't invest in the big diversified REITs. We definitely prefer the likes of Unite Student that is creating branded real estate. So their student accommodation buildings have their name on the outside, have their staff inside the building, and they have a direct relationship with the tenant, with the customer. In fact, these are businesses that talk in terms of customer satisfaction, net promoter scores, operating margins. It's really the next generation of real estate, and there's great choice across the 4 mega trends that we invest in. Within the digitalization megatrend, within logistics, you can get access to great big box assets. You can get access to urban logistics assets that facilitate same day, next day delivery. And you can get access to self-storage, which maybe 20-25% of self-storage is used by SMEs. And you could view that as their sort of e-commerce platform. So yeah, there's good choice out there if you go hunting.
And I mean, one of the issues that people have had, I guess, with open-ended property funds has surrounded kind of the liquidity and the mismatch between the sort of daily liquidity you might expect as an investor, and obviously the assets don't work like that. But perhaps you could talk about why investing through REITs kind of addresses that problem to an extent.
Yeah, Tom, great question. I mean, it's definitely historically the open-ended direct property funds have been a troubled experience for investors. So you saw in post the Brexit referendum results, you saw some funds suspend. With the COVID pandemic, you saw material uncertainty clauses activated by valuers, leading to suspensions. That has not been a good experience. Whereas if you look at the real estate investment trust market, the REIT market, which we invest in, every day that the London Stock Exchange is open, our investments are trading. So we've never gated the fund, we've never suspended the fund. It trades in a very liquid fashion, and that's great news for investors. They can get access to it on a daily basis. It's also great news for the companies that we invest in, because if they want to grow, they can come to the equity market and ask for new capital. We've certainly seen that in the likes of SEGRO in the logistics space, issuing new capital, Unite Student issuing new capital. And last year, Lok'nStore issued new capital. And what's interesting here, Tom, and maybe we'll get onto this, is they issued new capital, but they were trading at a discount. They issued new capital at £7.65 a share, £7.65 a share. A couple of months ago, they were actually acquired by a European peer, much larger company, Shurgard, for £11.10 a share. So they'd gone to the market, they'd issued more capital, and then actually they'd been acquired.
Yeah, that is really interesting, because another question, I suppose, is, obviously the REITs do give you the liquidity, but they, particularly more recently with the sort of interest rate backgrounds, I guess a lot of them have been trading at discounts. How have you kind of managed that? What's your sort of take on that situation?
Yeah, look, you're absolutely right. So we have had a headwind from interest rates. When we look at the underlying businesses, we want to invest in real estate that is growth income, not fixed income. So we want these secular tailwinds to benefit for those. We have an unashamed bias towards quality. So we prefer low leverage to high leverage. We prefer longer debt to shorter debt, more fixed rate debt. So that's enabled the businesses that we invest in, their top line's grown, their debt costs have been broadly fixed, and so their cash flow has grown. But you're absolutely right that the valuation yields have moved out. So property values, commercial property values have declined, and we have seen over the last 2 years, sort of 2 years worth of commercial property values decline. It's very rare for there to be a third year. So if you're an investor listening to this podcast right now, we'd argue it's a great time to be looking at the sector. So you've had the headwinds of higher interest rates. If you look at the futures market, the second half of this year is pointing to the Bank of England cutting rates. So that headwind abates. Maybe that headwind turns into a tailwind with declining interest rates. Property values have already declined. So why are REITs trading at a discount today, given that the values have come down, given that interest rates have probably peaked out? I think that's the bit of the head scratcher, and I think that creates the opportunity. Certainly creates the opportunity for us, and I think it creates an opportunity for your listeners.
And I mean, just broadening that out a little bit, have you got a kind of a wider view on the UK property market? I appreciate there are a large number of subsets within that, but do you have a take on kind of what the direction for that might be?
Yeah, so mixed, right? I mean, I think there's some areas that are going to be strong. So I think generation rent, so the build to rent market where you're getting professional landlords like Granger coming in, developing, owning, operating professionally managed rental assets, they'll do very well. I think we think logistics assets, urban logistics assets, where across the UK we've demolished urban warehouses to make way for residential tower blocks. The supply has shrunk at a time when demand has increased. Demand for next day, same day delivery of goods has increased. So demand outstrips supply, great for rents. Those type of areas are likely to exhibit good rental growth. At the other end of the spectrum, we think that those assets, office assets, secondary office assets with low energy performance certificate ratings are likely to struggle. So for England and Wales, the government has set that the minimum energy efficiency standard for commercial real estate needs to be an EPC, an energy performance certificate rating of B by 2030, or you will not be able to let or relet or trade that building. So someone's going to have to invest money to upgrade the stock. The alarming thing, Tom, is 85% of commercial real estate is rated C or below. So someone owns a lot of poor quality assets. If you contrast that to our portfolio, almost 60% of it is already future-proofed, and we were investing with expert management teams. So, the trend, if you look every year, the quality of our portfolio is improving. But out there in the secondary space, we think there are challenged assets. So certainly mind your eye if you're investing in a fund that's got exposure to secondary office. Retail, we're still skeptical on the opportunities for retail. Sure, the values have come off, but I'm sure you've seen the headlines as well that Body Shop went into administration.
Yeah.
Whoever takes on those stores is likely to pay less rent. Lord Wolfson at Next maps out in his annual report that he intends to keep cutting rents. So we think retail is still challenged, and so definitely our preference is next generation owners, operators of real estate. Avoid the old-fashioned let and forget assets. Be really careful, really choosy on office. Probably is still avoid much of retail.
That's really helpful, Matthew. And just kind of finally on the fund itself, what should investors' expectations be in terms of the kind of yields on the fund?
Yeah, so Tom, right now we think is a really attractive opportunity to get involved. The yield is 5%, around 5%.
Yeah.
What's really important to note is this is growth income, not fixed income. So if you look back over the last 3 years of the fund's distribution growth, and we distribute everything that we receive, in each year we've exceeded inflation. So the growth in the distribution has exceeded inflation. Even when inflation was 10%, our distribution grew by about 12%. This year, I think our distribution will probably grow at about 3%, maybe a bit higher. Inflation is probably going to come in 2.5%, 2.6%, say the economists. So 5% yield plus growth. If the underlying businesses to do their jobs well, that growth should exceed inflation. And then, as you mentioned, REITs are trading at a discount to their asset values. There's an upside potential. There's two ways of looking at it. There's the upside to the net asset value that you highlight. So right now, UK REIT land is probably trading at a 20% discount to net asset value. The long-term average discount is 15%. So there's upside there. The other way of looking at upside is looking at analyst consensus forecasts. What are they forecasting for the businesses that we own? 15% upside. So 5% yield plus hopefully better than inflation growth plus upside potential. What could be the trigger to crystallize that upside potential? I think interest rates being cut by the Bank of England could certainly spark a re-rating in the sector.
Thank you very much, Matthew. That was Matthew Norris, advisor to the Gravis UK listed property fund. Now on to our next interview. One of the key reasons why people invest is to generate an income from the markets. While shares or equity income funds are a popular way to achieve this, there are alternatives, such as investing in company debt. Traditionally, this might involve putting money into corporate bonds, but there is another way, as we're about to hear. CVC Income and Growth is an investment trust on the UK stock market, and it invests in leveraged loans. To learn about what these are, Dan Coatsworth recently caught up with CVC fund manager Peter Starlins to better understand this part of the market and the current state of play with corporate health.
So you invest in leveraged loans. I think for the average person might not know what those are. What are they in simple terms? And perhaps are they different to bonds that sort of the general public might be aware of?
Yeah. So there are two main differences between loans and bonds. So the first main difference is that loans have coupons that are floating rate in nature, which means the coupons move up and down as these are linked to base rates and indirectly actually underlying inflation, because central banks will move base rates up and down depending on where inflation is heading. Bonds, on the other hand, have fixed rate coupons. So you lock up your coupon for a long time. And sometimes in the case of government bonds, these coupons can be fixed for several decades. So investors indirectly need to take a view on inflation. And for a long time, people thought interest rates would stay at around zero forever and didn't really worry about protecting themselves against higher inflation. But in a well-balanced portfolio these days, interests or investors should have some floating rate interest and some fixed rate interest, because it's very difficult to take a view on where inflation is heading these days. The second main difference is that loans are senior secured in nature. And that effectively means that as a lender, we have security over all the assets that a company has. And we like to make the analogy with a mortgage versus credit card debt. So when you have a mortgage, the bank has security over your house. And if you default on your mortgage, the bank will repossess your house. And probably they won't lose too much money on that house if they can sell it in the market. With credit card debts, it's very different. The bank doesn't have any security over any assets, and you sort of promise to pay the bank back over time, but it's very difficult for a bank to recover their money when someone defaults on credit card debt. It's very similar in our world. So we have security over all the assets, which means that even if things go wrong, our recovery rates tend to be fairly high.
Okay. So, I mean, there's growing expectations for interest rates to be cut across Europe and North America where you invest. Is that actually negative for the income that you generate from your investments?
Yeah. So the answer is a little bit nuanced. It's not a simple yes or no. Of course, an interest rate cut will reduce the income we're generating on our portfolio. However, we've got plenty of headroom versus the dividends we're distributing, as the board has taken a fairly conservative approach towards dividends. However, in reality, you need to look at what is currently priced into the market. And if you look at what's priced in right now, the market is expecting that the Bank of England will cut base rates towards 4% by the end of 2025. So for investors who think that the Bank of England will cut interest rates faster than what the market is pricing in, say if they think base rates will only be at 2 or 3% by the end of 2025, you're probably better off in fixed rates exposure. If you think that the Bank of England will be very slow with cutting base rates, then you're better off in floating rate exposure, because you will get these higher coupons coming through versus what you can get in fixed rates debt right now. So again, indirectly, investors need to take a view on where inflation is heading, and if inflation is going to be more sticky than what the market anticipates, base rates will stay higher for longer and our asset class should outperform. But again, it's very difficult to take a view on inflation these days because there's so many variables with elections, geopolitical tensions. And so investors should have a well-balanced portfolio and have some floating rates and some fixed rates exposure in their portfolios.
The part of your investment strategy is to look for credit opportunities to generate, so that the growth part of the income and growth that's in your investment trust name. So in this sort of area, what are you actually looking for? And am I right in saying these investments are probably higher risk than the ones that are sort of generating the core income for the trust?
Yeah. So generally in the credit opportunity sleeve, we're looking at companies where the debt has sold off for a particular reason. Could be a change in regulation, change in competitive environment, or just management not executing well on their business plan. So we've got a large team of analysts, and we can tap into the wider CVC network as well to really understand what went wrong and what management can do to change the trajectory of a business. And so typically we would buy loans or bonds at 60, 70, 80 cents in the dollar, and we would expect a pull to par over the next couple of years. So if you look historically, we've generated around 15% return on our credit opportunities sleeve. So that's slightly higher risk, but it's also higher return. And given that we're still focused on senior secured debt, the downside is actually fairly limited because our recovery rates, even if there's a default, tend to be fairly high.
So, I mean, interest rates have actually sort of stayed a lot longer than people expected. They sort of stayed higher, I should say. Is that having a negative impact on corporate health? Because I guess we hear lots about the general public, consumers being under pressure from rates being high, but companies must be feeling it as well. Are we seeing sort of a lot of companies go bust in this sort of current environment?
Yeah. So when interest rates first started going up, a lot of people were worried about a big jump in corporate default rates. And to be honest, in our market, we have not really seen that happen. So default rates have gone up a little bit, but not materially. And one of the reasons is that we invest mainly in large companies. So large global companies tend to do better when in more difficult times than smaller SMEs. So when I look at the average revenue on our portfolio companies, so on average, these portfolio companies generate about 2.2 billion of revenues. If I, for instance, look at the average revenue on the company in the S&P 500, they only generate 1.9 billion in revenues. So we like to lend to very large global businesses, and these businesses have options. They can sell some non-core divisions to de-gear, they can raise some additional equity, they can cut dividends, they can cut capex. There's plenty of levers they have that they can pull to cope with a higher for longer context. And again, this is really why we have this large team of analysts. They speak to management teams regularly. They try to speak to the owners of the businesses to really try to understand what levers businesses have if interest rates stay high for longer, or even if they go up, which is no one's base case right now, if they go up even further. So, but we like to stress test all these portfolio companies we invest in, and the default rates across our portfolio has actually been fairly low over the last couple of years.
I mean, just finally, what's the sort of the trend for bank lending to companies since the global financial crisis? Because I presume that their risk appetite has diminished quite a bit.
Yeah. So banks have pretty much disappeared from our markets over the last 10 to 15 years. When I look back at pre-financial crisis, banks probably had about 80% of the loans that we're seeing in our markets on their balance sheets. And because of changes in regulation, they are just not allowed to hold these loans on their balance sheet anymore. And a large institutional market has developed over the last 10 to 15 years. And most of these loans now are held by institutional investors rather than banks. And if you look at some of these banks pre-GFC had a lot of leverage themselves, so you cannot hold loans that are levered themselves if you have a levered balance sheet. So institutional investors run a lot less leverage than banks, and we've seen banks leave our markets in general. They still originate the loans, but they would then syndicate it to a large institutional market where we're very active in.
That was Peter Starlins, fund manager on the CVC Income and Growth Trust. And that is all we have time for on this episode of the AJ Bell Money and Markets podcast. We hope you enjoyed the episode, and don't forget to subscribe so you never miss an episode. But until next time, thanks for listening.
Thanks, Laura, and thanks to our listeners. See you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.